tough month for stocks. Joining us now is Paul Ballew from Dun & Bradstreet's chief global economist. That's what he is. And Barbara Reinhardt is Private Banking America's chief investment strategist. Thanks to both of you for waking up early for us. So we were talking about a couple of things. First of all, Becky, when she started the show, was talking about an op-ed today by Lloyd Blankfein in the Wall Street Journal. Then we were talking about Obama here sets this tax rate, and we decided that this isn't going anywhere fast. Do you have how we talk about this fiscal cliff and rising above all the time, but how important ultimately is all of this to where we are right this second?
Well, I think that it's important for us to take a look at the fiscal cliff in its context of this year and also next year. It's not necessarily how much of the fiscal cliff expires. It's the incremental drag to GDP. So this year we've got about a 1% fiscal drag. Next year we're looking for about a 1.5% fiscal drag. It's the incremental fiscal contraction in GDP that really matters for the economy.
As you look at this, the bigger question for us is we think there'll be a compromise going into January, maybe on December 31st, given what Washington's doing. But the bigger question is, what are we doing long term to support growth? And that is a question. If you're going to raise revenue, are you going to do things that are going to support long-term economic growth to go along with it? Inevitably, you have to reform entitlements. The question is how. Right. So for us, there's only so much that we think will impact in 2013. It's beyond 2013. That's the big question.
In this handicap, is this just a small deal that gets done? I mean, we are now talking about big deals. All of the conversations about big deals, big deals, big deals. But is that what's when you try to estimate what's going to happen?
I think it's important to keep in mind that the big deals are probably going to take months to get sorted out, if not 12 months or longer than that.
So then what does that do to your GDP estimate?
So you bridge 2013. You assume that there's some type of a compromise to elongate the status quo, maybe make some tweaks on the margin, and then you focus your time and attention on a broader compromise, which is really required for the long term.
Because this issue actually happens though, because when things are back end loaded, a lot of times they tend to not play out the way we're expecting.
Absolutely.
The same thing as Bush tax cuts.
Sequester, right? So we're living that right now. We're hoping that it does, because if you don't, you'll continue to get this burden on the economy, and we don't want to see 1.5 to 2% growth into the middle stages of the decade, because keeping in mind 1.5 to 2% growth means 120,000 payroll jobs a month, no real gains in income, all of those drivers that
and you don't get back to 5.5% unemployment till like 2020 or
and you'll depress investment returns. You'll have all of those other factors that go along with it. So inevitably you have to get a compromise, and the compromise has to be meaningful, because this isn't just about tax rates and marginal tax rates. This is about some very big structural issues. $30 trillion in unfunded Medicare.
Let's talk about Europe and the impact. You saw John Chambers out last night with Cisco's earnings, but Europe was the weak spot, and he said it wasn't getting any better.
Well, look, Europe is definitely in this kind of muddle-through scenario. You've got a couple of issues that have to be resolved for Europe. Greece was given somewhat of a reprieve in terms of their financing that they have to do this week. There's a big EU summit coming up at the beginning of December. You need to see movement on two fronts for Europe. Something more towards a banking union, of course, would be very positive for the markets. Right. But incrementally, you also need to see something on better growth for Europe as well, because you need to see Europe have a credible way to start to grow their way out of their debt crisis. It can't just be, austerity only.
Right. What is your sense, though, in terms of the fiscal cliff vis-a-vis Europe? Meaning,
a more severe issue in the near term, clearly, because Greece still isn't on a sustainable path to stay in the European Union for any, or the Eurozone.
If we go over the cliff, what happens to Greece?
Well, you just get contagion around the globe, because you'll get a substantial drag from the U.S. We think about this.
We don't talk enough about the sort of global implications.
Well, the global implications are severe, not just because of the U.S. We're talking about fiscal drags around the globe in all developed markets. If you look at the run-up in debt and structural imbalances, it's global in all developed markets, even Germany. Everybody talks about Germany as this rock star. German debt is at 80% of GDP from a public sector standpoint. So you start adding all of this up.
Their economic performance has suffered recently, too.
Well, and clearly Europe's going through at least a mild secondary downturn, and when we look at that, it's spreading into the northern parts of Europe, so I wouldn't expect any relief from Europe. The real question right now is the strength in China and the strength in the U.S.
Well, there's 2 points also that you're kind of missing. There's a big drag in the second and third quarter of this year to global economic growth. You're actually starting to see the turn. It looks like a lot of the data that came out of China over the past week has been far more favorable, and also the data cycle in the U.S. has started to turn up as well. So that you've kind of been through this soft patch through the second and third quarter of this year, and you're actually starting to see some marginal improvement in two of the big economies. That's why the emerging markets are behaving relatively better than the developed markets over the past few weeks.
Okay, Paula and Barbara, Paul and Barbara. Why did I say Paul and Barbara? Thank you so much for joining
Paul
us.
and
Thank you.
Barb.
I could,
But would it probably be two women, though? Probably.